We look at the three key ratios that you should consider as an investor, and the first one is EPS. EPS is one of the most common ratios used in the financial world. This number tells you how much a company earns in profit for each outstanding share of the stock. EPS is calculated by dividing a company's net income by the total number of shares outstanding. And knowing this ratio is very important for stock investors, but understanding its limits is very crucial. Executives have a lot of control over various accounting practices that can impact net income and earnings per share. Make sure you understand how earnings are calculated and don't just take EPS at the face value. Then price earnings ratio. It is a common ratio which takes a company's stock price and divides it by earnings per share. This valuation ratio means it is used by the investors to determine how much value they're getting relative to what they're paying for a share of stock. P ratios can be calculated using trailing earnings or earnings that have already been earned, as well as forward earnings, which are projections for what the company may earn in the future. For fast-growing companies, looking at the forward PE ratio may be more useful than using historical earnings that can cause the ratio to be elevated. But remember, always remember as an investor, that projections are not guaranteed, and many stocks of companies that were once thought of as fast growers suffered when that growth failed to materialize. The PE ratio can also be inverted to calculate an earnings. By taking earnings per share and dividing by the stock price, investors can compare the yield easily to other investment opportunities. Then return on equity. It is very important to understand this ratio. It is a measure of how good a company is at turning its shareholders' money into more money.